Good afternoon. My name is David Auerbach. I'm the Managing Director of Armada ETF Advisors. Joining me this afternoon is Brian Mitz, the Chief Financial Officer of NexPoint Residential Trust. Brian, great to be here.
Thank you.
In Dallas, Texas, at my old office building at the Crescent. So used to work one floor right downstairs, if you recall.
I remember.
Way back when. So for a general overview from their most recent investor presentation and from their most recent earnings, as of May 31st, which is your most recent investor presentation, they own 41 multifamily properties consisting of just under 15,400 units in 11 markets in 7 southeastern and southwestern U.S. states. As of June 3rd, the portfolio was over 94% occupied with an average effective monthly rent of $1,378 per occupied unit. One of the unique things about NexPoint is what I call their tenant renovation program, and we're going to discuss that well in depth in our conversation today. But during the second quarter, for the properties in their portfolio, they completed 650 full and partial upgrades and leased 609 of those upgraded units, achieving an average monthly rent premium of $138 and a 24.9% return on investment. Since its inception, in what year?
2015.
So since the inception in 2015, for the properties currently in their portfolio, they've completed 6,834 full and partial upgrades, 4,724 kitchen and laundry appliances, and 9,624 technology packages, resulting in a respective $142, $48, and $43 average monthly rental increase per unit, and a return on investment of, again, respectively, 21.8%, 69.7%, and 33.5%, meaning they put the money into the properties, they're seeing return on investment on those properties. So we're going to discuss all of that. So Brian, to kick us off, tell us about NexPoint and the why of the company. And obviously, I do want to hammer on that tenant renovation as it is a very unique aspect of your business model.
Sure. So NXRT is a multifamily REIT, Class B value add. We're focused on about 10 markets in the Sun Belt. I think the why that I would stress is there's a shortage of housing in the United States, particularly affordable housing. And that's what we're focused on. As you saw in here, $1,378 average rent, which is pretty low across the country, particularly in the markets that we're in. So I think the why is we're focused on the right geographies where we're seeing migration, household formation, as well as the affordable aspect. And we're meeting that demand. There's high demand as our occupancy shows, as we continue to have just endless supply of tenants and residents that want to move into our units.
Can we highlight those let's maybe look at your, let's say, top 5 of those 10 markets that you're talking about. Like, what are those markets for those that are watching, and maybe the why of those markets?
Yeah, Dallas, Atlanta, Tampa, Charlotte, Phoenix. All of those have seen incredible in-migration from typically usually New York and the Northeast and California. So that's why we focus on these markets. They have that undersupply of housing plus a growing supply of residents and households moving in.
Well, as you mentioned, Dallas is your top city. With us both being based here, we know how crazy the housing market is. Mm-hmm. The housing market has not slowed down here to the extent that it has in a lot of the other cities across the country. Of course, we're seeing data from Redfin and Zillow every single day talking about, these migration trends that you're referring to. And I've used this example before, like my neighbor just a month ago sold his house right across the street from me, and it was on the market for less than a week.
Yeah.
And he got 3 offers on it. So it may have not been 10 offers like it was a year ago, but we're still in a hot market, as you mentioned. There's still millions of homes lacking in supply. And so the roof over your head is that most important investment decision. So,
Yeah, that's right. What hasn't slowed down either, it certainly spiked during COVID and has maybe settled down a little bit from COVID, but it's still at the levels pre-COVID where you're having migration into these markets. As you know, in Dallas, there's tons of jobs being created. Companies are moving here, moving their headquarters here, or substantial parts of their operation. So all those people need a place to live, and then those jobs create other jobs, and those people need a place to live. So it just feeds on itself.
I mean, it's funny because we're sitting here in the Crescent, and when I was here several years ago, they were struggling to get tenants in, if you recall, and now they're like 98% occupied. I believe, like they're almost full on this property right now. So there's no question, because of our great tax abatements that Texas is offering to companies to relocate, it's no wonder we're seeing this massive demand and influx of. Tenants.
Certainly Texas and Florida, I think, are the big beneficiaries of that migration. States like Georgia, Tennessee, the Carolinas, Arizona, even Vegas, they're seeing a lot of it too. But I think the big winners are Texas and Florida.
So not on the list, but then what's next? Like, what would you, again, just out of your mind, what would you envision that next relocation to be? Is it Omaha, Wichita? Like, where do you guys see the next iteration?
I think we're pretty happy where we are. We recently entered the Raleigh-Durham market, and I think that's a kind of the next market for us that's seen a lot of growth. A lot of that is around tech and life sciences. It's got the research triangle there: Duke, North Carolina, Wake Forest. It's got a lot of kind of high. It's like a Boston almost with the intellectual capital in that city. So that's our next move, and we've already entered that market.
That's great. So what is it about the middle income properties in Sunbelt cities that you do find so appealing?
I think that's where the biggest shortage is, and I think that's where where people focus the least in the public markets, at least. If you look at the big multifamily REITs, they're focused mainly on the coasts, very high-end product, $2,500 a month type of rents. So very, very different than our resident base. And so no one's really meeting that need. There's a few other REITs that have started over the last few years to kind of emulate what we're doing. Mid-America has always been very good at it, in a company that we look to emulate ourselves after. But that's the reason why. There's just much less competition from our perspective in those markets and in that segment.
I do want to go back to the tenant renovation stuff because, again, I feel like it's just one unique angle that you guys have done differently than a lot of the other peers, like IRT as an example. Kind of walk us through the process. You buy a property or you're doing a property review or something. Can you maybe just kind of walk us through the steps and how it all works?
Yeah, so our average properties are about 25 years old. So they're older. As any house or any building that you have that's older, it's not up to the current either construction standards or aesthetics. So we go in, we look at doing probably about 60% of the units. Plus we do a lot of the general amenities and common areas. Maybe some of these older apartments don't have gyms, or if they do, they're not very good. They're not up to the current standards. They may not have a dog park, so we'll put a dog park in. They probably don't have a business center, or not a very good one, a very big one, particularly with work from home now. We saw that become a bigger amenity. We also fix up the leasing center. That's the first thing that a potential resident sees. We make that more inviting, more open, more kind of modern looking than what it would have looked like if you built it in the 90s, which is when a lot of our properties, or even the 80s, a lot of our properties were built. So that's what we look to do with the rehab is, and then as you mentioned on here, we had washer and dryer. A lot of our apartments don't have that. And one of the key things to making it a Class B or better apartment is you can do your laundry in your unit instead of going to a common area or even off property. Same thing with the tech packages. I mean, that's something that wasn't put in place in the 90s, obviously.
What does that mean exactly?
So it's like your Nest thermostats. You can have keyless entry. You can lock a door without being there. You can unlock it without being there. So it's just and you can loop everything together in your apartment. You can have speakers, and so it's more of a just an overall tech setup within your apartment, which is things that you'd think maybe at $1,378 a month is a luxury, but it's really becoming a requirement. And that's why we've done almost 10,000, about 2/3 of all of our units. We put that in up till now.
What are you hearing from your tenants and prospective tenants? What do they want? What do they look for?
They want $2,500 type of product for $1,300.
Don't we all?
So, we try to get there. We use some of the finishes that we use they're not real granite. It's like a faux granite. It's not real wood floors. It's faux wood floors, but they look just as nice. It gives that same impression. So I think that's how we're meeting their demands and needs. But again, there's a shortage of housing. So, really what we're trying to do is to be the best of breed to create that property that they want to live in and still make money.
That's great. That makes a lot of sense. How do the rents in your portfolio compare to rents on like the new construction in your markets? Is the differential enough to protect you, do you think, from the excess supply? And do you see supply a going concern into 23?
Yeah, not for us. There's a pretty substantial difference of $500 or more between our rents and what rents are for newer build products. So it doesn't really impact us. Now, what could happen is we could have what we call the trade down effect, where if someone's struggling to make that $2,000 a month rent payment, we give them a property that's almost as good as what they're renting for $2,000. So even if we hit a recession and some of the bottom tier of our residents can't make payments or can't afford our product, there's another level that will move down. So that's why we don't really see and don't anticipate a big disruption if we do see a recession. We still think we can be 94, 95, 96% occupied.
So again, we're talking about affordability. The affordability of your Class B and middle income portfolio is a key differentiator. What are your thoughts about demand for the product under the current conditions that we're seeing? Rising interest rates, rising inflation, recession, if we're in it, if we're out of it, like where do you view us right now?
I think food and shelter are the two key things that everybody needs. And so they cut other places first. I think as far as affordability, if you look at rents and the increase in rents up and down the spectrum, the higher rents are accelerating as fast, if not faster, than our rents. So that continually gives us room. What we've always looked at is what's that differential in the whole dollar amount. If it's the next best option, which is maybe a lower class A type property, is that $250, $300, and that still gives us a lot of room to move rents and still not that resident looking to move, because you got to think about the cost of moving. That's a couple months rent maybe, or the differential in your rent. So there's a good gap between where we are and where the next best options are. So from affordability perspective, we also look at what percent of our residents' income is going towards rent and their living. And right now it's about 25%. In a lot of other areas, it's 33%. Typically, if you're owning a home, your costs are about 33% of your income. In some higher price markets, it could be 40% or more.
I was thinking, what would it be like in New York and LA, as you mentioned?
San Francisco, Seattle, all Boston, all those markets, which is one reason we're not in those markets. It's hard to get an affordable product in those markets.
40%. Wow. Well, I guess it leads into that next question. Does the renter by necessity with that $75,000 average household income range hold up if unemployment starts to rise? We are in a three-handle strong environment right now. What percentage of the portfolio do you see is currently in two-income households?
There's probably a decent percentage of the portfolio that is two income earners, but a $75,000 a year household income can be a $120,000 household income today that becomes a $75,000 household through layoffs or whatever as a result of a recession. That's where you see that trade down effect. So our $75,000 a year resident may move to $50,000 because one of the spouses loses their job temporarily. And if they do, there's still unemployment. I don't anticipate that we would see the same sort of unemployment that we did during COVID. That was a unique period, but there's still unemployment available. And again, people find ways to make their rent payment. If they live in a nice place that they like, particularly if it's a family and they're in a school district they like, they're going to do everything they can to not have to move out of there. And there is a cost of moving too. So
2 months, you said. 2 months salary.
2 or 3, the differential. Now, if you're trading down, obviously you're saving money. So, maybe that's less of a concern than if you're trying to move out and move up into a different, higher quality or higher grade of apartment.
I mean, you make that interesting point, though, about you'll do whatever it is for your kids if you're in that right school district. You're going to find
absolutely.
a way to make it work so that they're getting the best education possible. You're getting the best surroundings possible for the most bang for your buck, let's say. Well, so has the migration trend from the higher cost northern markets run its course, or do you still think we have a long runway to go here?
No, I think it continues. We did see it accelerate during COVID, and I think it's dropped back down since COVID. But I think COVID just added a new reason. The states, Texas and Florida, they're getting the biggest benefit. Were also the ones that opened the fastest during COVID, had less restrictions. And I think a lot of people in California, New York, not to pick on those 2 states, but that's where the biggest migration's from, didn't like being told that they had to wear masks everywhere all the time, or had to be vaccinated to do anything, to go into a restaurant. I mean, I remember that in New York. You had to have a vaccination card to go to a restaurant.
Mine in my pocket.
I have mine as well, but don't really use it in Texas.
I haven't used it when I've been on the road recently either in New York or California or these places.
Yeah, I think everything has moved back, but I think the fact that residents went through that and don't want to go through it again, and know that if they come to Texas, and there's other reasons to go to Texas and Florida and some of these other states as well in the Sun Belt. And look, that migration isn't new. I mean, that's been happening for decades. People moving into the Sun Belt. It's become more of a real city. Dallas, Orlando, Tampa, Miami, certainly Miami, is almost like a coastal city. It's almost like a San Francisco, New York. It's high cost, but it's cosmopolitan. But some of these other cities like Atlanta, Dallas, I mean, those are real cities now. And it's not the same moving from New York to Dallas as it was maybe in the 70s or 80s.
Same thing with
Austin, Houston, Nashville, Charlotte. I mean, there's a lot of cities that, and not coincidentally, we're not in Austin, but we're in those other cities.
Well, you think about for us, again, in Dallas, property values for so long. And then just it jumps up like everybody, like that catch up was just, it wasn't slow and steady. It was like a steep pickup there.
Yeah.
I mean, it was, I don't want to say overnight, but it seemed like it was almost overnight.
Yeah. And you've seen that around the country. I mean, housing prices have really exploded, and 20% year over year increases, which is crazy. But it goes to that shortage of housing. The supply demand is pushing prices up. Same thing on rents.
Right. Let's turn now towards the company itself. NexPoint remains one of the higher, or if not highest levered apartment REITs. How do you respond to critics who say that your leverage is just frankly too high?
Well, I think we have the highest growth also, not necessarily in the number of apartments we buy and own, but in our, and consistently have in how we're growing our NOI. So what we've always said is we grow into that leverage. If we buy an apartment for $250,000 a unit, and we have a clear path to $300,000 a unit or $325,000 a unit, that's a very different leverage profile than when you bought it at $250,000 a unit. So we kind of grow into that leverage. Not sure the market agrees with that or believes that, but that's historically what we've done. And I think it's paid dividends. It's been a great story.
All of the company's operating metrics are flashing green, and the future looks very bright. So why would you say the stock's trading at let's say a 30% discount to NAV per your estimates? Do you believe it's management's role to proactively try to close that valuation gap?
Yeah, I'm not sure what we do as a management team if that isn't our job. And all we can do is continue to take advantage of the marketplace and continue to position ourselves to take advantage of what we think is going to be coming down. I would say that all residential REITs have traded down, maybe not to a 30% discount, but a 20-25% discount to NAV. And I think that is people's impression that interest rates move up, cap rates have to move up, values have moved down. We likely end up in a recession if we're not already in one. How does that impact your ability to continue this growth, et cetera? So although growth is as high as it's ever been, I think people are discounting that because they think that it's going to change in the next year or 18 months.
Well, as you mentioned, your same store NOI growth was 16.4% for 2 quarters in a row. Do we see moderation into the second half of this year? What about into next year?
I think in the fourth quarter, it starts to decelerate. Just the law of numbers. We started to see these increases in sort of the second half of 2021. And so now when we're comping year over year, it's a tougher comp. And then certainly as we get into 2023, I think you're going to see a slowdown in rent growth and NOI growth. But that'll be across the board, not just our company. That's residential in general. We'll see that. But it'll still be if we go from 16% to 8%, so it cuts in half, that's still a very historically high growth rate year over year for NOI.
Do you see it being a 50%? Again, I know we can't look into the crystal ball, or do you think it's going to be more of a gradual?
I think it'll be more of a gradual, unless there's a deeper recession than I think most people are anticipating. But I think it'll be gradual. The 16 to 8 was an example. I don't think we see a 50% drop. At least
almost
not
like another massive COVID or some just extraordinary circumstances.
Maybe not even then. With COVID, we saw all the stimulus, which is why we're in this inflationary period. But I'm not so sure the government doesn't do that same thing if there's some kind of, and hopefully we deal with the pandemic differently. We've got a little bit of a benchmark and saw how it worked, and particularly the way the different states handled it. Hopefully there was some lessons learned there. But, I think we still are somewhat recession resilient as a strategy. So I still think we'll have a more gradual decrease in NOI.
Well, now comes that fun question that I know you get asked all the time. Externally managed REITs get the cold shoulder from analysts, investors alike. Do you see potentially any plans to internalize in the future? And if so, what could be those motivating factors?
I think we do still get some of that. There's still a bias against externally managed. But I also say a lot of times we've traded at a premium to our NAV. We've raised equity at a premium to our NAV. So I think we've largely overcome the stigma, at least us personally, because it's worked. We took this company public at 14 a share in 2015. I think it went as high as 95, 96 a share before this recent pullback. So we don't see any reason to really change that. Is there a catalyst that would change that? If we doubled the size of the company, and I don't mean by market cap, but if we went to 30,000 units or 45,000 units, maybe then we start to look at to internalize, because that becomes a different setup. But unless we get that, I just don't see us ever internalizing.
So if we could crystal ball, let's say 5 years down the road, could you see the portfolio doubling in size?
No. If you look at the history, we've always been kind of between 13,000, 15,000 units.
That's the sweet spot.
Yeah. And we've grown the company from like 500 million market cap to 2.5 billion market cap. So we don't need to add properties to grow. That gets back to the rehab and that internal growth story that we have that's fairly unique across the other multifamily public REITs.
You guys have started going down the tiptoeing into single family rentals. Mm-hmm. So can you discuss, some of the what we call the cousin enterprises, NexPoint Diversified, Vinebrook? Mm-hmm. Do you think that NexPoint, NXRT would ever go into the single family side of things, or because of these entities, they're kind of standalone as itself? Basically, talk about single family rentals.
Well, so we'll start with single family rental. We like that business a lot. It's very similar in fundamentals to multifamily. Now, operationally, it's very different to operate that many different assets. And just to give you an idea, we've got across our different platforms about 27,000 single family rental homes. So, which I think makes us the 6th largest owner operator in the country. And so that's a different operational challenge than multifamily. As far as merging those or blending those together, I think it's certainly an option. I think we're seeing today some of the multifamily REITs get into single family rentals. And that may become the new norm where it just becomes residential versus multifamily and single family. So I think we have that option available if we want to take it. But I wouldn't sit here today and say that that's something we've put a lot of thought into or think that that's the future of NXRT.
What is the differentiator between Diversified versus Vinebrook?
So Diversified has a large exposure to single family rental, but a lot of that exposure comes through its ownership in Vinebrook. So also in our ownership in NexPoint Real Estate Finance, which is our mortgage REIT, which has a big focus on single family rental as well. So a lot of the single family rental that we have in Diversified is actually through debt and not direct ownership.
Interesting. Off the script, what's your thoughts about M&A in the residential REIT space? I know you guys are different again because of, externally advised where you're at under the bigger entity here. But what do you think? Too many apartment REITs? Not enough? Like, where do you think, what's your view of the landscape out there?
Yeah, I think there's probably the right number. And I think you saw some consolidation sort of 14, 15, 16. And you probably see that again if stock prices remain depressed, but the fundamental backdrop remains positive. And it's going to be the smaller ones. You also have sort of the Blackstone effect where they raised so much capital. They've started buying whole companies. They bought Blue Rock. They bought Preferred Apartments. American Campus. I mean, I think, the smaller multifamily REITs are certainly, I would think, in their sights. We've not been approached by them, but
I was going to say, should I put Jim and John Gray in touch with each other? Maybe they could have a chat.
I mean, it'd be worth a conversation. But they haven't reached out to us yet. But I got to imagine that they're looking for places to put that capital to work, and they can't just buy apartment buildings. They have to buy massive portfolios to make it make sense.
What's different about the company today than when you guys launched in 15, as you said? Because we're in a whole different operating environment.
We didn't know it at the time, but I mean, that was probably one of the best eras ever to own multifamily, and certainly our segment of multifamily. Today, I think it's a little more challenging that we've had that kind of great 10-year run. And so we're kind of on the back end of it. Now I think it's, gets down to really, truly good management teams that can navigate through sort of what's out there. And again, the fundamental backdrop is incredible. There's a shortage of housing. We're providing that and filling that demand, and not many others are. So I think we're an exceptionally great place, but definitely a different environment than we were 7 years ago.
What would you go back and if you can go back and talk to yourself from the day that you're standing up there ringing the opening bell on your IPO launch, what would you tell yourself?
Well, over the years, we've had people approach us to buy the company, and we decided not to. And I think that was the right decision. I'm not sure we would do a whole lot different. Houston has been a market that's still it's performed, it's done well, but it's been one of our worst performing, relatively speaking. Maybe do less in Houston and expand more in some other markets. But I think overall, I wouldn't really change much about what we've done.
So let's try and bring this back full circle as we wrap up here. So if somebody is living, let's say, in the villages down in Florida near some of your markets, but they don't know about NexPoint, and they're learning about our ETF, what we're trying to do at House, and learning about the residential space, what would your one message be to try to get across to that prospective investor?
Yeah, I think affordable housing that is nice, and it presents as a higher grade than what other Class B operators are putting out there. It's a great resident experience, and I think for the $1,300 a month, I mean, if you've seen any of our properties and seen what we do, particularly the before and after, I think that's a powerful. Pictures are worth 1,000 words type of message. I would encourage people to go online and look at our our property and our product.
And that's why NexPoint is a constituent of the Home Appreciation US REIT ETF. You've heard it from the man himself here tell you about the why of NexPoint. And so, Brian, I really appreciate you spending some time with us today, and I hope we can do this again soon.
Yeah.